Hi there and welcome to August's edition of the Rubicoin podcast, coming to you from the top floor of Rubicoin HQ here in Dublin, Ireland. I'm James Dunn, and with me as usual is Emmet, Rory and Meabh. This month we're going to talk about the changing face of the video game industry, just how big $1 trillion is, and bust some interesting jargon in our news section. One of the biggest stories from the past month was Facebook's earnings day massacre. The social media giant shed almost $120 billion from its market cap after reporting a miss on earnings and forecasting slower growth over the next few years. Rory, do you think such a sell-off was justified, or was it just a bit of an overreaction by the market?
Yeah, I mean, that's a hard one. It was the single worst drop in market history for a single day in a dollar amount. Considering, just a quick look at the actual earnings report. So they grew revenue for the quarter 42%, which for a company this size is really incredible. They're talking about revenue growth slowing down to about 25 to 30% for the remainder of the year, which, is a drop, of course, still making a lot of money.
Yeah.
Their operating margin is going to fall from 50% to somewhere in the mid-30s. And again, just to put that in perspective, mid-30s means this is an incredibly profitable company. By far the most profitable of the FANG stocks, way better than Apple or Google. I mean, I don't think Google's ever reached that kind of operating margin before. And I think what was most surprising about this release was just how surprised everyone was. Facebook have been telling us for years that this kind of thing was coming. In the mid-2016, they talked about their ad load and how they were going to have to basically pull back on advertising because it was making the experience poor. I think they were too late at that stage, personally, But even then, in previous releases, they've been saying the same thing. Just last quarter, they said they were going to be investing heavily in safety and security, basically doubling the amount of staff in that area to 1,400. They told investors that this was going to cost money, that the expenses were going to rise to 50 to 60% over the next few quarters. And they also said they were playing around with the algorithm in order to reduce the amount of kind of spam and clickbait users see. And the problem with that is that's where a lot of their advertising revenue is coming from. So I think the real question here is the message from the market that Facebook needs to clean up its act and reinvent its business? Or is the message from the business world saying, hey, all this cleaning up you're doing is costing a lot of money and we thought there was a lot of cash left in this cow?
Yeah, so it's kind of they're trying to find that balance between, making money and fighting fake news.
Exactly, yeah.
Mm-hmm. But I think a lot of novice or new investors haven't seen many of their stocks hit speed bumps, and it's just a natural progression in business life that as you grow and get larger, something has to be done to correct the trajectory of your business, and that's what we're looking at here with Facebook. There isn't a business that I can think of that didn't have an equivalent moment as Facebook is facing right now. So for me, it's almost not news. It's just the way it goes. That's all the rite of passage on its way upwards.
Yeah, but on the flip side of that, perhaps though, it's these fake news concerns and privacy concerns are a huge concern for many people. Mm-hmm. And maybe you can elaborate more on this. Is investing in Facebook in some ways become more of an ethical concern for investors, do you think?
Yeah, well, we talked about this in a previous podcast around the time of Cambridge Analytica.
Yeah.
And I think I said something along the lines of that personally I wonder whether the privacy breaches will start to affect market sentiment.
Yeah.
And Rory, you just used a phrase there. I think you said clean up their act. So in which way are they going to clean up their act? And my thoughts at the moment on Zuckerberg and on the platform is what exactly are they cleaning up? There's a show, Dispatches, it's on Channel 4 for anyone listening. That's a very popular British TV channel. And it had a kind of an expose of the content moderators working for Facebook and affiliated Facebook companies in Dublin, in their Dublin office. And I'm not going to get into the detail, but I mean, that's a tough job. And the platform has huge problems when it comes to illegal, offensive and upsetting content. And it is not being moderated in an aggressive way. And that is Zuckerberg. He is not governing it with an iron fist. He's not really doing what I believe he should be doing. The platform now has dark tendencies. We've seen it in influencing voters with Brexit and with other, kind of voter electorates. And I'm just curious about Facebook's, not ethics, but future when it comes to making sure that actually the platform is not so politicized that it's damaging market sentiment.
Mm. Yeah.
Yeah, totally. I mean, you hit it the nail on the head there. Facebook's business model is kind of based on this idea that one, first of all, outrage sells. People enjoy getting outraged online. It's there's also an element
we're
of like
addicted to outrage.
Totally, absolutely. And there's also, like Facebook naturally puts people into these echo chambers where they only really hear what they want to hear. And then finally, in order for advertisers to be able to target people, they end up fine slicing people into these tiny groups. And think about those three things and how someone with kind of more nefarious purposes could use that information in a wrong way. But just on Zuckerberg, I think it's like it's interesting that he's one of the few public CEOs in the world who's basically unfireable because of that sweet dual share system that they've got.
Yeah, I mean, in that Cara Swisher interview, that Recode interview that we chatted about before this, Rory, you brought it up, he mentions that if there's anyone to fire based on the privacy breaches, it would be him.
Yeah, but
so is he been ironic there? Or?
Well, yeah, I don't know. He is unfireable essentially, and he's in a very weird position now where like he can kind of do what he wants, and most public CEOs have to answer to shareholders. He doesn't really. So it kind of comes down to Zuckerberg's motivations. Do you think he just does he care about money, or is he kind of more egotistical in terms of trying to create this fantastic platform and be known as this amazing business leader? And I'm not so sure about him, but I think he probably leans towards the latter, and so in that sense he probably has a bit of scope in which he can clean the thing up.
I wonder.
Another major upset from this year's earnings season was Netflix, who dropped more than 15% after reporting a miss on subscriber numbers. Emmet, though the share price has recovered somewhat since then, is it time to start worrying that the world's hit peak Netflix?
Well, Reed Hastings and his team have been remarkably good at meeting and exceeding guidance to date. I've watched the story closely for a very long time, and we're all used to seeing Netflix smashing all numbers. In the last quarter, we heard from management that they expect to meet the targeted 10% profit level for the year, which is up from 7% last year, and it came in at around 12% in Q2 or 11.8%. But to the question, to use movie parlance, when we cut to wide shot, what is in store for Netflix? And I believe the growth story will continue. I believe they've seen a reduction in plan numbers in the US. But it's a big world, there's a lot of broadband, and this year they're spending $10 billion, an incredible amount of money on content that only they will own, and therefore they will keep subscribers, they will acquire new subscribers. And while the stock fell from something like 400 to mid 300s, as you said, it's back up again. But Netflix has a share in the wallet of millions of people, hundreds of millions of people around the world, and that's something that I see growing.
Yeah, and that's a good point that, Netflix, they've got a lot of subscribers, and, you could make the argument, particularly in the US, that they're reaching a saturation point of some level. But as you mentioned, it's a big world out there with a lot of broadband and a lot of people getting onto broadband or even just acquiring internet. So that leaves Netflix with a lot of room to grow internationally.
It's the rebirth. We're witnessing the rebirth of how television is consumed. So between Disney and Hulu and Prime and Netflix, of course, these are the channels of today, and we all grew up with cable channels, and we're basically looking at the business model being redesigned, and the whole value chain has been re-engineered by Netflix, starting at distribution, which typically was the last step in a movie home or movie house. So Warner Brothers would start with the movie and then push it outwards. Netflix, by design, started with how movies were distributed, and now they've gone right through into the heart of Hollywood and are producing fabulous productions, box sets, TVs, series and movies, and we're all addicted at some level. Yeah,
and Maeve, I know myself and yourself were having a conversation before we came in here today, and you were talking about not just how good Netflix are at getting subscribers, but how good they are at keeping subscribers.
Yeah, I think it was a conversation that came up in the office around their decision from an experience design point of view to personalise the artwork that you see on the content. So by that I mean when you go to choose something new to watch, or if you skim past something that you've watched before, some people, depending on what A/B test you're in, will notice that the actual cover artwork has changed. I have a very brief thing to read here, which is probably not going to be totally understood, but just to give you an idea of how much they're thinking about this from a design point of view. They use something called a contextual bandit.
Okay.
All right.
Sounds ominous.
Would anyone like to know what a contextual bandit is?
Yes, mate.
Yes,
okay.
so.
Bear with
Rory,
me.
you're not allowed to answer.
Bear with me, colleagues and listeners. So For artwork personalization, the specific online learning framework that Netflix uses is called contextual bandits. Rather than waiting to collect a full batch of data, they use contextual bandits to skip the need to gather big data, and the contextual bandits go ahead and basically present an unbiased model, and then will give each member a personalized artwork based on previous choices and context.
Oh, wow.
So now I'm not expecting anyone to really understand what I just read, but I'm reading from a medium.
I said a wow there just to sound intelligent. I was like, wow, I don't know what you just
Well,
said.
I'm reading from a medium piece that's, I mean, this piece is probably a couple of thousand words long, and what it does is it goes through the amount of effort they put into this artwork personalization process. I experienced it in real life, which was noticing that every time I scan past Mad Men, which is a show that I've watched a number of times, they present a different image of Don Draper, which is nice.
Yeah.
And then also I've watched The Crown, which is a very popular Netflix original show about the royal family, twice I think. And what it did for me recently was it presented cover artwork of the three corgis.
Right.
Which
They know you so well.
You know, I wondered whether it was becoming sentient, but no. I think what it does is it studies what people click on and what people hover on. So whether you like a more illustrative style or whether you like more a photographic style. And that is the detail that they're going to make sure that subscribers are retained, you know, and that is just one of the design details. So that's serious.
It is, absolutely. I mean, not only do they own $10 billion worth of content in this year alone, but they have customer analytics at a level that we don't even know.
Exactly.
Yeah. Moving on then, last Thursday, two of the video game publishers we feature in the Invest app, that's Activision Blizzard and Take-Two Interactive, reported on their earnings from the last quarter. Rory, how does the world of gaming look at the moment?
Yeah, so you mentioned those two companies and they both reported, and there wasn't huge news from either of them in particular. They've got future releases coming up, which is where the real what people are really looking forward to. But just as looking at the gaming in kind of broader sense, you know, I really think gaming at the moment is experiencing a kind of almost renaissance period.
Yeah.
On a couple of fronts, you know, for one thing, this kind of we've talked in previous podcasts about microtransactions and how these are kind of driving revenue for companies years after the release. Activision Blizzard have been pretty good at this, and Take-Two, I mean, if you look what they've done with Grand Theft Auto 5, you see just how successful they've been in this space. I think last I looked, they brought in $6 billion from that game.
Yeah,
and that was released. It was released 5 years ago now. It's still making a huge amount of money for them. But then on the other side of that is esports, which you know, every company now is talking about getting into esports, and with good reason. I'm sure a lot of our listeners will think it's kind of bizarre, the idea that you would sit down and watch other people playing video games, but yet esports already has a much bigger audience than most traditional sports. It's predicted to be the second most watched sport in the world in a number of years, just behind soccer.
Yeah.
I think it's interesting this is kind of happening, to your Netflix point, Emma, it's kind of happening in conjunction with the rise of over-the-top streaming. So, you know, for years we had kind of these gatekeepers in the television companies telling us what to watch, and when we give people the option of watching whatever they want whenever they want, it's funny that a huge amount of people gravitate towards esports. So yeah, it's got 380 million viewers worldwide. That's growing at about 20% per year. It really kind of mimics traditional sports in a lot of ways. You've got professional teams. Some are geography based, some are kind of clubs where they pay players to play for them.
Yeah.
You've got leagues, you've got superstar players with their own fan bases, and you've got big sponsorship deals. And, you know, it's not just kind of gaming hardware companies that are sponsoring these. You're talking about big companies like Coca-Cola, MasterCard, all the major automakers are getting involved. And you got to remember that the people who are watching this are actually a very tough market to reach. And you think about the kind of outlandish valuation that was put on Snapchat when it first went public. The whole bull argument there was that these are millennials and you can't get near them.
Yeah.
And, you know, if you look at who's watching esports, they're kind of mostly young males, but with a growing number of females. They're more highly employed than the average internet user and make more money than the average internet user. So these are highly prized eyeballs, especially in the world of kind of marketing and merchandising. So if you're a publisher right now, it's a great time, you know, it's a great time for you because you basically own the content that is driving all this, and it's still very early days, particularly from a monetization point of view.
Maeve, how do you feel about watching people play video games?
I'm not so sure on this one, but that was what Rory just kind of ran down through there has given me a better appreciation of it, because now I understand the demographic. Like, would it be a wild guess to say that a lot of these people are working in games or technology?
Probably, yeah.
So I have an interest, but I guess, I have watched some friends play computer games for hours, and it's led me to want to go crazy. So I'm not sure.
It's a movement or an industry, if you like, that you almost have to see it to believe it. So if you're not actually a participant, or if you don't have somebody close to you who's completely addicted to it, it probably doesn't feel real. But then when you hear the numbers that Rory has spoken about, it dawns on you that this is something giant that might be outside your scope of interest, but
That's
doesn't detract from the fact that it's in mega growth.
Well, I remember like when we were playing video games when I was a kid, you'd be over at your friend's house, and if it was a one-player game, you'd be kind of sitting there sad because you have to watch someone else play it. I'm sure anyone who has a brother, has felt this experience before, and like watching your friends play is very boring.
Oh,
but,
it is. Yeah.
The people who these guys are watching are like very highly skilled competitors, and they want to. If you want to see the best of the best in a game that you're interested in, this is where you got to watch
watching
it.
together as well, it kind of almost makes it like an immersive experience.
Oh, totally. Yeah.
So that changes it. So maybe I'll be into esports. Who knows?
It's definitely transforming gaming from kind of a media space to a social media space as well. So yeah, I think there's a lot of growth for these publishers.
Cool. And finally then, we couldn't take a look at the past month without acknowledging that the world's most famous fruit company has finally hit the $1 trillion market cap. Can anyone tell me exactly how big is $1 trillion?
So Webster Dictionary has two definitions. The second of which is it's an indeterminately large number, which I thought was quite funny.
That's
because
pretty
it's
fair,
not indeterminate. It's actually 1,000 billions, or 1 million millions. But $1 trillion is a number that is very hard to grasp because it's just a word that you just know is huge or indeterminately large. Wall Street Journal a couple of years ago, 2 years ago, wrote a piece on the Freedom Tower, that magnificent, majestic, giant building that now commands, center stage in New York City.
Yeah.
The Freedom Tower is 104 floors high, or 541 meters up. It cost to finish level $3.8 billion to build the Freedom Tower. Which, by the way, is the exact same rate or price for the New York Yankees team. If we went to buy the New York Yankees today, the most valuable sports brand in the world, we'd pay about $3.8 billion.
Okay.
So you could say the Freedom Tower is equal to the New York Yankee team. So when we take $1 trillion and divide it by 3.8 billion, we get 260. You could build 260 Freedom Towers for the price of Apple today, or $1 trillion. That is an entire city. And that is not just a normal building in a normal site. It is the middle of New York City and the proud centerpiece of the city at the moment. So to kind of imagine what $1 trillion is, if you've been up to the top of the Freedom Tower, if you've stood at the base and looked upward and realised what an absolutely incredible structure it is, imagine 260 of those, a complete forest of Freedom Towers. Another way of looking at $1 trillion and bringing it back into our world is in the Invest app. If you bought all the small cap businesses in our showroom in their entirety, it would come to something like 28 billion. If you bought all the mid cap companies in our app, the total bill would come to something like 400 billion. So we're not even at $500 billion yet, and you've bought 2/3 of the companies that we have researched and put into our app. So let's keep going. We have 7 ETFs, and I'll speak a little more about ETFs in a while. If you bought all the ETFs in the app, in our Invest app, and all the mid-cap companies and all the small-cap companies, you would still have over $100 billion in change to buy some nice stuff for yourself. $1 trillion is like, it is truly a ginormous number. It is massive.
That's pretty incredible when you put it like that. It's actually quite funny because soon after Apple hit the $1 trillion market cap, I saw a news article come up, and I think the headline was how Apple will reach the $2 trillion market cap. And I think it was maybe a few hours after they hit $1 trillion, so the pressure's on for them now.
Yeah.
Over the last few episodes of the Rubicoin podcast, we've started asking you to vote on the segments you'd like to kill or keep for next month. We're doing it again this month and giving you the power to control what you want to hear in our next episode. To start off, we're going back to our companies we never talk about. This is where Emmet and Rory pick one stock from our showroom that they feel doesn't get the attention it deserves. Rory, we'll come to you first this month. Which stock do you want to shine a spotlight on?
Yeah, so the one I'm looking at this month is Planet Fitness. And I remember looking at this business first and thinking it wasn't a very attractive investment. It's gyms. There's loads of gyms out there. There's very little each of them can do to differentiate themselves. But we looked a bit closer and very glad we did. So we quickly came around. The founders of Planet Fitness realised pretty much long before anyone else two things. One, most gym users only use a small subsection of the equipment. So while other gyms were racing to get the most elaborate stuff in there, they were filling the places up with treadmills and exercise bikes. The second thing they realised is that a lot of people only go to the gym casually, and if you're one of these people, the gym can be quite intimidating. So they created this notion of the judgment-free zone, which I think someone's going to have a question for me after this. So really what they did is they carved out a blue ocean opportunity for themselves, one which had fewer competitors, and because now, even though they're just selling gym membership, it's actually a totally different thing, appealing to a totally different type of consumer. And there's no doubt this strategy has paid off for them. Last quarter was their 45th consecutive quarter of positive comp growth, up 11%. It's led to a 33% increase in overall revenue, and they now have over 1,500 locations. And just one final point I'll make is retail, as we know, has been going through a tough time. This means there's a lot of vacant, cheap property out there, and so Planet Fitness, all they have to do is wash, rinse and repeat at this stage. The stock's up 130% since we recommended it. It's worth acknowledging it's a fantastic management team. I think it's at a premium valuation right now, but any pullback could be a great buying opportunity.
I have a question.
Go for
and
it.
I'd like to dispute your judgment-free zone claim.
Yeah.
I read a story recently about a certain gentleman who decided to exercise nude in a Planet Fitness gym.
Yeah, we all read it. Funnily enough, the stock actually popped the next day on the kind of belief that this was going to become a kind of internet sensation,
viral thing.
a kind of similar to the Kiki dance that's going on at the moment. I don't know. We'll wait and see if that pans out.
So, Emmet, what company do you want to shine a spotlight on this month?
Well, I'm going to talk about the Dividend Aristocrats ETF. I mentioned ETFs a moment ago, and just for our listeners' sake, an ETF or exchange traded fund is a collection or a basket of tens or hundreds or sometimes thousands of stocks or bonds in a single fund. And an ETF is traded on a major stock exchange like the New York Stock Exchange or NASDAQ. So ETFs are a wonderful way to diversify instantly. They come with less risk, less work and lower costs.
Yeah.
So we often talk about the S&P 500 ETF here, and Vanguard is the daddy of ETF makers, if you like, and it has a family of ETFs that anyone can buy through their full service or online brokerage firm. So the Dividend Aristocrats is an ETF, and it is basically its constituent parts are businesses that have increased their dividend payouts for 25 consecutive years or more. And the reason that I'm particularly keen on the Dividend Aristocrats is that here in Rubicoin, we look for growth opportunities. We focus on businesses with great management, great track history of performance, a unique product, a diverse customer base, etc. And we're looking for appreciation in stock price. We very rarely think about are these businesses paying a healthy and regular dividend. The Dividend Aristocrats allows an investor to immediately buy the top tier dividend payers and a whole basket of them in one fell swoop.
Yeah.
So the Dividend Aristocrats was launched by Standard & Poor's or S&P just around 13 years ago, and it has historically performed the S&P 500 index with lower volatility over longer investment timeframes. Or to be a little clearer on that, over the past 10 years, on an average annual basis, the S&P 500 Dividend Aristocrat has returned 3% more than the S&P 500 index. And businesses that we know and love are in there, such as Coke and Colgate, McDonald's, Pepsi and Walmart. big established businesses that at the end of their year have money left over in the bank account and return to shareholders like us through a dividend. And a wonderful way to diversify your portfolio in the dividend world is with this ETF, which I think is my all-time favorite ETF and is one that I'm a huge fan of.
So yeah, kind of a good way, a good foundation to put at the bottom of your portfolio, I suppose.
Absolutely.
A consistent gainer,
Absolutely.
I suppose, yeah.
And it's very simple. The criteria is the businesses within have increased their dividends for a quarter of a century, and there's a big bundle of them. So if any of them discontinue or drop their dividends or stop paying dividends, there are enough businesses in the Dividend Aristocrats to smooth that effect out.
Yeah, I think it's it's a sign of really diligent management as well. If you think a lot of these companies have gone through two major recessions or two major stock downturns, and they not only have they managed to keep paying their dividend, but they've increased it.
Absolutely.
Cool, so that's the companies we never talk about. Next we're going to move on to I Read a Book. Maeve, I think you're going to give the intro here.
I am, because you're the person who read the book.
I am.
Which is good news, and also reminds me that it may be me who's talking about a book that I read next month, which is a nice refresher. So I know what the book is. James, I'm going to let you take it away, but I am going to say what it's called. So it's called Bad Blood by an author called John Carreyrou. And I just want to ask you one question, which I think is quite important. Can you please tell us whether this book proves whether we cannot trust someone who commits to a turtleneck?
Yeah. Well, I think that should be a rule you kind of live your life by in general, perhaps with the exception of Steve Jobs. But so the book I read this month was Bad Blood by John Carreyrou. He's a Wall Street Journal reporter and a 2-time Pulitzer Prize winner. And the book is about the famous Silicon Valley unicorn Theranos. So for those of you who don't know, Theranos was a biotech company founded in 2003 by a 19-year-old lady called Elizabeth Holmes. Holmes was a Stanford dropout who wanted to create a way to test blood in a variety of different ways using a significantly smaller amount of blood than you would get from a typical intravenous straw. So this might not sound like a massive development to anyone not in the medical industry, but one of the big things I learned from the book about drawing blood was that you need quite a big volume to do the multiple different tests, and there's wastage and spoilage and stuff. So that's why when you typically get a blood draw, so much blood is taken. Theranos was groundbreaking because they were taking a minuscule amount of blood through their finger prick technology, and they'd signed partnerships with Walgreens, Safeway. By 2014, this company had raised more than $400 million and was sitting at an estimated value of $9 billion. Ultimately, though, none of the equipment they produced actually worked.
That's a bit of a humdinger.
Yeah, it's a bit of a problem. So the equipment they produced wasn't reliable. It actually emerged that Holmes had bought equipment from another blood tester and was using that equipment to get the results, not using their own equipment. They were actually also diluting the blood they were taking with saline solution, which was giving back false results. There was a lot of interesting aspects to this book, not least the massive fraud that was carried out. There was also a huge amount of dysfunction within the company. Holmes was notoriously paranoid and secretive. There was a huge employee turnover. Many people who raised concerns about small things like the fact that the equipment didn't work were fired on the spot. Anyone who raised ethical concerns about
It's just a small thing.
Yeah, just a small thing.
By the way, boss.
Get out, you're fired. How dare you ask a capable question?
Anyone who raised ethical concerns about the fact that there was real people here testing the blood and getting back false results, they were also fired. It's pretty incredible. But for me, not to ruin too much of the book for you, but for me the most interesting part was the cult of personality that was built around Elizabeth Holmes. If anyone's ever watched an interview with her, she cuts quite a striking figure. She's got these kind of really large doe eyes, really blue eyes. She wears the turtleneck, as been already mentioned, and she speaks in this very, very baritone voice, which according to the author of the book is actually put on in order to give her an air of authority. But
Margaret Thatcher did that too.
Yeah, it's pretty incredible to listen to. But if that wasn't enough, what really struck me about this was the board of directors she'd built up. So coming around 2012 2013, the kind of heyday of the company, sitting on the board of directors was George Shultz, who was the former US Secretary of State, Henry Kissinger, also former US Secretary of State, a guy called William Perry, who was the former US Secretary of Defense, And a name that many people might know is General James Mattis, who's the current US Secretary of Defense. All of these people were sitting on the board of this company that was ultimately committing massive fraud. Now, this was by no means a partisan board either. Holmes is well known to the Obama administration. She was invited to numerous White House events, and she'd kind of just created what Carrie Yu describes in the book as this reality distortion field that caused people to momentarily suspend disbelief. In other words, she cut such a striking figure, she obviously was able to convince people so well that what she was doing was right and, visionary and breathtaking, that they decided, I suppose, not to perform due diligence and actually, go in and see this for herself. Now, granted, there was fraud committed in the fact that, results were fudged and things were hidden, but it's unbelievable to think that, such a massive company was built up essentially on the personality of one person. And I think we can probably take a lot of lessons from that today.
That's incredible. It's one of the few books that, when I looked on Amazon, had something like 700 reviews that were virtually all 5 stars, and I think it's number 7 in the charts. I hadn't heard of it until you mentioned you'd read it.
Yeah, and I suppose probably what's so interesting as well is that it's still an ongoing case. So Theranos as a company still technically exists now. I think they've laid off pretty much all of their employees, and Holmes and her business partner have been indicted by a federal grand jury at the moment, but she still maintains innocence. She's still fighting against it, really.
It seems like, I haven't read the book, but is it one of those things where, like, if you tell a big enough lie and tell it more frequently enough, people will believe it?
Yeah, I think it's very much the kind of snowball effect that you kind of overpromise, and then you have to keep that up, and it just kind of spirals out of control. But yeah, it's a brilliant book. It's well worth the read. It's very, very readable book too. Carrie Yu is a well-respected journalist, and it's written as such. It's a real page turner. But pretty incredible story, and I think a kind of warning to maybe us as investors, that when we're investing in companies, to not just go on the cult of a personality. So that again was I Read a Book, and the book this month was Bad Blood by John Carreyrou. So over the past month, we got some questions in from users about various phrases and terminology used in investing. We decided to make a section out of it called Jargon Busters. In this section of the podcast, we're going to go through some of the most commonly used phrases in investing and kind of pull them out a little bit. Maeve, this idea was yours.
Yeah, so I think we're probably sticking to the knitting a little bit more with Jargon Buster than some previous segment attempts, because we think you guys listening really want to talk about anything and everything to do with direct investing. So we get user and customer requests that say, hey, I don't particularly understand this phrase. And we also get people saying, what can I read, or what part of the Invest app can I learn about the things that I wouldn't know as a novice investor? So what I did was I thought about, I suppose, some of the phrases and terminologies that for me, when I was a novice investor about 3.5 years ago, took me by surprise or I found interesting. And just as a nice segue into this, I read a piece on, is it Quora or Quora? Quora. I read a question on Quora that said, can someone explain to me why it's called the bull and the bear market? And I had always assumed it's because the bull is an animal who'll push forward, and the bear, possibly when cornered, will retreat. But I was wrong. It's quite a nice explanation. It's basically to do with the way in which the animal will attack. So a bear will attack by swiping downward, depreciating market, and a bull will always attack by driving upwards with its horns, so an appreciating market. So that's not exactly busting jargon, but it's getting close to talking much more about investing in a way that will kind of pass on knowledge for what things mean.
Yeah.
So the first ticket that we got in to try and bust jargon is someone who doesn't understand what we mean when we say double or two-bagger. Double-bagger or two-bagger.
The term was introduced, certainly to my consciousness and perhaps to everyone's, by Peter Lynch in his book One Up on Wall Street, which I think all agree is the perfect starting point for new and intermediate investors if they want to read a book from one of the investing masters. But anyway, to the point, it's a terminology that Peter Lynch refers to as a stock that doubles in value. Two-bagger or double-bagger is a stock that doubled. A three-bagger went up threefold, and so forth. So it's a very simple way of just referring to a stock that has doubled in value for you. So you buy it for $20. If it's currently at 40, you've got a two-bagger.
Another ticket we got in was from a user who wanted to understand what the phrase adding to their positions meant. Rory?
Yeah, I mean, that's, if you start a position in a stock, maybe, you see a stock at $40 and you buy a couple of £100 worth. Later on, 6 months down the line, you might see that stock at $50 or maybe at $30. And, rather than entering a new position in different stock, just means that you're using your current money to add to your position. So you're just adding more adding more of the same stocks to your portfolio.
And to your mind, is there any difference between positions and holdings? I know those phrases are often used quite interchangeably, but
I'd use them the same way. Position.
I would
and
too.
holdings.
Yeah. And adding to a position is a standard practice across every type of investment manager, from Warren Buffett through to the newest starter in the investing world. So it's just good practice, because if you liked it at $100, you should like it at 80.
Can you tell me what a reverse split is?
Absolutely. So there is a generally accepted trading range in which people like to see a share price, and it's evolved over time. And in the US especially, a stock that's lower than $5 a share is commonly referred to as a penny share, or is incorrectly perceived as a cheap business. Might necessarily be true. And stock shares that are several $100s in value or more are seen as inaccessible. So a new investor might look at a single share in Amazon and say that's too expensive for me, which isn't actually correct logic, but let's pause that for now. So what managers of businesses do is they occasionally try and keep the share price trading within a range. So if we issued shares in Rubicoin and it went up to $10,000 per share, it will by default exclude a lot of investors because a single share costs 10,000. So what we might do in that situation is issue a stock split, and that means that the math of the business stays the exact same. You just have more shares at a lower share price. So if we did a 2-to-1 share split in that situation, we would have double the number of shares in Rubicoin, but they'd be $5,000 each, and so it continues. So nothing changes, but it just brings your share price down to a range, or up to a range that puts your business and therefore your shares onto the radar of investors. So stock splitting is simply, as its name suggests, splitting something down the middle. If you take a sandwich and split it in two, you still have the same sandwich in two halves. It's the same volume.
Okay, gotcha.
So that was our slightly extended version of Jargon Busters. So to move quickly on, as we're quite pushed for time in this month's podcast, we're just going to get to our elevator pitches before we finish up. The theme for this month's elevator pitch is a company listed on a US exchange that was founded outside of the US. Rory, I'm going to come to you first. Give me 30 seconds, and I'm going to have to be strict on time this month for once.
Okay.
30 seconds.
So I'm going for Diageo. It's the world's largest spirit maker based in the UK. They own Guinness, which just made up the road and a favourite amongst Rubicoin staff, not naming any names. They also own Johnny Walker, Smirnoff Vodka and Tanqueray Gin, to name a few. Over the past few years, the company has been trading up their middle shelf brands to more top shelf brands, and this is working out very well for them. Those brands grew 14% in the last quarter, and I think this premiumization is going to be a long tail for the company. Just quickly, and I'm short on time, but can't talk about a UK company without mentioning Brexit. Obviously, it's going to cause a bit of short-term volatility, but Diageo sell to 118 regions in the world, the majority of which aren't in Europe. And with the British pound down so low, their costs are depreciating, and it's more attractive for foreign buyers to buy their product.
Cool. We'll give it to you.
Okay.
Right, Emmet, 30 seconds. Go.
So Shanghai-based Baozun provides end-to-end e-commerce solutions for brand partners in China. It's a $3 billion business with $100 million in cash and is led by its founder, whose name I won't attempt. It's 36% owned by the founder. Big brands try to enter China and fail, such as Barbie from Mattel and Home Depot and eBay and countless other businesses. Chinese e-commerce spending is giant. It topped $1 trillion last year. There's that number again. Baozun allows businesses to do it very easily, seamlessly, and they're integrated with the biggest marketplaces and social networks in China, like Alibaba, JD.com, Weibo, Tencent, WeChat, and so on. And their revenues are growing like mad, and it's one of my favorite stocks at this moment. 45 seconds.
So, Maeve, who do you which elevator pitch have you been sold on this month?
Emmet, you said the word trillion. Baozun.
Okay.
Yeah, there was nice uniformity there. I like
exactly.
that. I go with Emmet too.
Well.
Fine.
So,
He's just left.
For those who can't see us but are listening, Rory is slowly turning around in his chair.
So in the same way as last month's episode, we want your help in deciding which parts to kill and which parts to keep from today's episode. If you go to the Rubicoin Twitter page now, you can vote on the 3 sections. That's companies we never talk about, I read a book, and the new section, Jargon Busters, to let us know if you'd like to hear it again next month. If you miss out on the Twitter poll, you can still let us know what you think. You can get in touch with us on Twitter or on Facebook, leave a comment on the podcast episode itself, message us through either the Learn app or the Invest app, or email us at pod@rubicoin.com. That's pod@rubicoin.com. If you have any other suggestions for completely brand new sections, we'd love to know. That's about it from us from this month. As always, there's plenty of other new things to check out in the Invest app at the moment, including our brand new Stock of the Month report that was added on Tuesday of this week. Thanks for listening in, and please make sure to rate, review and share the podcast if you enjoyed today's episode. From myself, Emmet, Rory and Meabh, happy investing.